So the first step to buying a home is getting pre-approved with a lender, mortgage consultant, mortgage broker, loan advisor. They all pretty much do the same thing. We all have an NMLS number that permits us to do a loan application, quote rates, and get pre-approvals. The three things that lenders look at is credit, income, and down payment. Basically, the lender needs to see stability from a home buyer. So they're asking for at least 1 year of credit history with good credit rating, stable credit payments, 2 years of employment history, and a minimum of 3 to 3.5% down payment for first-time buyers, depending on the program. Now, there are different types of programs that allow for bad to no credit. There are down payment assistance programs that allow for no down payment. So there's many different programs that your lender will advise you and fit you in, but just for the regular conventional or FHA loans, you need at least 3% down payment. For a conventional loan, good credit history means 700 or higher FICO score, and a 2-year stable employment history, whether you're self-employed or W-2 employee. Once you meet with your lender and your lender looks over your income and your credit, they will most likely tell you the maximum loan amount that you can be approved for, the maximum that the bank will give you. But you want to discuss with your lender, not the maximum of what you can get, but what you're comfortable with paying. So are you comfortable bringing 3% down payment, or do you need down payment assistance program? Or can you bring more? Your lender will tell you what kind of funds you can use for down payment. They can be your own funds that are sourced, seasoned in the bank account. They can be a gift from a family member, but absolutely no cash. So what the lender will look at besides your income and your credit, they will look at 2 months of your bank statements. They will ask you about any large deposits that were posted into your bank account, and they will tell you not to make any cash deposits into your bank if they can't be used for a real estate transaction and just will be backed out. Your lender's also going to go over with you about closing. 2 months. So depending on the program, if you have really good credit, sometimes you can get away with 1 month, but usually it's 2 months, 60 days of bank statements. Your lender also is going to go over with you about closing costs. These are fees that are paid outside of down payment. So besides the 3 to 3.5% down payment, you're going to need funds for closing. And those closing costs include prepaid items such as taxes, property taxes, insurance, also fees, there are title fees, appraisal, possibly inspection, and lender fees. Typically, closing costs are at between 2 to 5% of the purchase price of the home, depending on the transaction. Sometimes closing costs are paid by the seller. Sometimes they're split 50-50. Sometimes your realtor will get you seller credit to cover closing costs, but this is something that is not known until you're actually in a transaction on a home. So you want to plan for at least 2% of funds for closing costs on top of the down payment. Your lender will also go over your monthly payment with you, which includes the principal and interest on the loan. This is an amount that does not change if you have a fixed mortgage. If you have a 30-year mortgage, no matter what happens, your principal and interest payment will always be the same for 30 years. Your payment will also include taxes, insurance, and possibly mortgage insurance. Taxes and insurance is not determined by the lender. Taxes are set by the county, and that amount can change yearly depending on the county you live in. It can change a little, it can change a lot depending on how your home is assessed. Same with insurance. I've gotten a lot of calls this year because insurance in California went up quite a bit. Because of the fires that happened, a lot of insurance companies left California. A lot of them are raising insurance and doubling. And people are surprised, calling, my payment went up. Your payment for your loan will never change. It's the payment that for taxes and insurance will go up. And there might also be, if you do a 3% to 3.5% down payment, you most likely will have mortgage insurance. Depending on the program that you're using for your financing, mortgage insurance can stay on for the life of the loan or until refinanced, or it can be removed after you have enough equity on your home. So your lender, besides monthly payment, besides closing costs, should also go over the type of program that you're getting for your loan. There are multiple programs available between government loans to private loans, but most common loans are conventional loans that require 3% down payment for first-time home buyers. The great part about conventional loan is that the private mortgage insurance that you pay when you bring a little down payment gets removed once you have 20% equity. So whether your home grows in price, whether you pay it off faster, you can always pick up that phone once you have 20% equity, call your lender, and they will remove mortgage insurance. But conventional loans require a good credit score. So the higher your credit score with a conventional loan, the lower interest rate you will get, but you do need about a 700 plus credit score to get a normal interest rate. There's also government loans like an FHA loan, VA loan, and USDA loans. FHA loan is typically a loan that is given for a riskier borrower, somebody who doesn't have great credit, somebody who might have had a bankruptcy, somebody who is deemed not acceptable by a conventional loan. FHA is not a bad loan. A lot of realtors are scared of FHA loans. There's a lot of rumors regarding FHA loans. FHAs are great loans, especially for first-time buyers. Especially now, they do allow for 3.5% down payment. Their interest rates are lower than conventional. The only reason that FHA is getting a bad rap around is because the mortgage insurance is non-renewable unless you refinance. And also an FHA loan has something that's called upfront mortgage insurance. So besides paying monthly mortgage insurance, you will get mortgage insurance added on top of your loan. So it's 1.85% of the purchase price, of the loan amount, I'm sorry. And then there's VA loans for veterans and USDA loans if you're buying a house outside of the city. So, like wheatland parts that are rural. There's also down payment assistance programs. There are grants, there are loans that you can get, there are forgivable loans if you live in the house long enough. Right now there's a new down payment assistance program coming out next week, which will give you up to 20% of the purchase price as down payment assistance. This money has to be paid back when you refinance, if you sell, or you pay off your home. In addition to the 20% that you have to pay back that they give you, you have to pay back 20% of the equity that you've earned on your home. So for example, if you're buying a home for $500,000, they will give you up to $100,000 towards down payment at zero interest. Let's say 5 years down the line, you sell your home for $650,000. You have to pay them back the $100,000 that they gave you, plus $30,000, which is 20% of the $150,000 that your home increased in value. Full guidelines are not available for this program yet, but if you're interested, it's going to come out next week. We'll have more details, and we can go over that with you.
Katya, is that down payment assistance program? I know the policies are not implemented yet, but I heard from my client that this is a temporary program.
Yes.
Okay.
Yes, so the program, there is no set time. They set an amount. The program will give up to $500 million for residents in California. Once they're done with the money, the program will be gone. So if you think about it this way, if you buy a $500,000 home and they give away $100,000 to each person, that's only 5,000 people that they could help. Last year they had a program when they did a 10% forgivable equity, and that program lasted about 5 to 6 months. So I expect this one to go faster than that.
How much they have to give away?
500 million.
500 million. Mm-hmm. Thank you.
Yeah, so once your lender goes over your payment, your program, and all those details with you, you will get a pre-approval letter. You can can use this letter to meet with your realtor, start shopping for a home, and put in an offer. While you are shopping for a home, please do not open new credit, get anyone to check your credit, or make any large credit purchases without confirming with your lender. Do not change your job without consulting your lender. Do not make any large financial decisions until you talk to your lender. The smallest things can affect your credit score. I had an incident last week where a person was in the process of buying a home. We were close to closing, like 3 days away from closing, and they decided to start furniture shopping. And they went to RC Willey, and they told them they have a 0% interest program. They applied for a credit card, we got an alert, they bought a couch, and they no longer qualified for the loan, 3 days away from closing. So they had to go back, give back the couch, have RC Willey write a letter saying that they returned the couch, that they have zero payment due, and it postponed our transaction by, I think, 5 or 6 days because RC Willey took a while. So please, please don't make any large financial decisions if you want to purchase a home without talking to your lender. Once you find a house of your dreams or your choice and you get in contract, you and your lender will start working closely together. Your lender will collect any additional documentation or any updated documents that they will need to submit your file to the bank, to the mortgager. What a lender is basically your face, your representative in front of a financial institution. They present your file, they build a case for you to get a bank or a mortgage lender to approve your funds with as little headache for you as possible. Once your application is submitted, whoever your mortgager is, there are multiple lenders. A lot of people think that they have to get financing through a bank. This is not true. There's a lot of private money lenders. There's a lot of mortgage companies that do financing. So it's not only Wells Fargo, Bank of America, or Chase that does mortgage loans. Actually, they're slowly pulling out of the mortgage business because they can't provide the same terms as private companies can. So once the application is submitted, you will be sent electronic disclosures. These first disclosures are like a rough draft of your loan application. A lot of information will be incomplete or might be inaccurate. This is your chance to go over with your lender to correct any information that might not be correct. Before your lender submits the application to the bank. Your lender will also order an appraisal, your realtor will order any inspections, and your file will be submitted to underwriting. An underwriter is a representative of the bank, mortgager, that makes the decision on your loan based on the application that your loan officer submitted for you. Once an underwriting is done looking at your loan, you will receive a conditional approval, basically a list of any additional documentation that needs to be submitted to get your loan approved for closing. Once those documents are submitted, once appraisal comes back, when inspections are done, you are going to move to closing. Your underwriter is going to send a clear to close. You will be scheduled to meet with a notary to sign all the documents that you've signed electronically to this point in front of a notary. Those final documents are going to be correct with no mistakes. You're going to go over them one more time just to make sure there are no mistakes and everything's right. Sign them in front of a notary and the lender will fund your loan. Once your loan is funded, once it's recorded with the county, you can get your keys. And a lot of people think that that's when your relationship with your loan officer ends. However, your loan officer is going to be your best friend for life, and you want to keep in touch with them for any refinance opportunities, for any purchases that you might want to do in the future, investment properties, home for your kids. They will guide you how to correctly be financially prepared to make any purchases in the future. Your loan officer will monitor mortgage rates for you, and they'll pick up the phone next year and say, or 2 years from now and say, hey, rates dropped by 2 points. I think you can save some money by refinancing. And hopefully you and your loan officer will have a great relationship for many, many years. Even if you're not planning, a lot of people think, oh, I'm not planning to buy a home in the next year. I'm not planning to buy a home in the next 2 years. It's too early for me. You want to talk to a loan officer. They will guide you. They will prepare you. So when you are ready to buy a home, it will be an easy and smooth process. So that's my information. If anyone has any questions, feel free to reach out to me. I also have an office here at USCO and can meet with you anytime that's convenient for you. Do you have any questions?
What